Be Wealthy and Smart, episode 815.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about stocks, precious metals, and crypto, because they're some of the hottest things going right now. But in one of these areas, I'm seeing a reason for caution, and I want to share that with you today. So first of all, we saw all three indices for stocks hit record highs: the NASDAQ, the Dow Industrials, and the S&P 500. So bravo, that's exciting, and it's always great news to hear that the stock market is hitting all-time highs. But there's some caution signs that I want to talk with you about. A few I've talked a little bit about before, but now we're seeing things really start to get extreme. And it's a little bit concerning because we have some important things happening today. We have Tesla coming into the S&P 500 today, and massive rebalancing happening across 500 different companies because of the indices having to have different percentages of ownership of Tesla and all of the other S&P 500 companies. It's also a quadruple witching day, which occurs on the third Friday of the month every quarter in March, June, September, and December, and it refers to the simultaneous expiration of single stock options, single stock futures, and stock index options, and stock index futures. Now, most of the time, quadruple witching is a non-event. You don't really even notice that it's going on. But I'm just telling you because there's a lot of volume that's going to pass through the market today. And that can be cause for more volatility for sure. But that's not really what I'm concerned about. What I'm concerned about is a particular chart that I saw yesterday from Real Investment Advice. And this chart is a chart of the S&P 500 versus corporate profits after tax. And normally, at least if we go back to 1970, there's a high correlation. In fact, most of the time, these two move almost exactly together, where the S&P 500 and corporate profits after tax are right next to each other. The only times that they got a little bit away from each other were in the year 2000, when the S&P 500 got much higher than the corporate profits after tax. And we all know what happened. The stock market went down for 2 years until they met up again. And then also in 2008, when they declined together because of the financial crisis. Right now, what we're seeing is this open jaw, where the S&P 500 is up at 3722, and again, broke a record yesterday. And we're seeing corporate profits after tax decline to 1,400. So the corporate profits after tax are less than half of what the S&P 500 is right now. And like I said, they usually move together 1-to-1. So to have such a disparity, to have corporate profits after tax way below where the S&P 500 is a bit concerning. And the reason that institutional investors are leaving the stock market and have been leaving since September, even though we keep hearing about new highs, the reality is the big money is moving out, and the insiders, the corporate executives, the CEOs, the C-suite, they're selling their stock and getting out of the market because they see the fundamentals are deteriorating. You see, the difficult thing is right now there's a lot of new investors, and they're treating the stock market like it's a casino where you bet on your favorite horse, which is your favorite stock. And that's not how investing normally works. Even though that strategy has been effective this year, it has, I understand. But that's not normal investing. The way you find and value good businesses, which is what stocks are, is by the numbers or the fundamentals, like what are their sales, what are their profits, what are their net earnings, things like that. If you have fewer profits, is the company worth more or less? Well, if the company's making less money, theoretically, it should be worth less and its stock should be selling lower. But that's not what's happening now. Because of this casino atmosphere, stocks are rising and have separated from the fundamentals. And they've been that way for a long time, ever since I was pounding the table in March for us to get back into the market and buy in a big way at the lows. I talked about how there was going to be this tremendous disconnect between reality and the numbers. But at some point, they had to come back together and they had to reconcile to one another. And we still aren't seeing that yet. We're seeing this dramatic separation, bigger than ever, in terms of where the stock market's gone and how poor corporate profits are. So the casino can continue and can go on and on as long as there's new investors to come in who are willing to buy. But at some point, that stops. And then one day the casino doesn't work anymore, because the numbers eventually have to be paid attention to and reconciled with the stock price. So all I'm saying is these differences between the S&P and where it's trading and corporate profits after tax, well, that's just never been wider or a bigger disparity since 1970, according to this chart. And that means caution is warranted. Doesn't mean that the casino will end right now or that the bubble will pop right now, but it does mean that time is running out and we have to either get corporate profits back up, which is unlikely since a lot of the country is shut down or in the process of shutting down, especially some of the more populous states. And also we're seeing higher unemployment, we're seeing spending come down a bit, we're seeing some unusual trends happening that show us some weakening in the economy. Now, we're also seeing people move out of the big cities and real estate benefit from that, where people are starting new construction, real estate has been strong, and interest rates are at record lows. So, all I'm saying is while we're at record highs and we could go to higher highs, just be aware there is risk in the market that is not being talked about. Nobody's buying put options anymore. Everybody's all in on call options. That's a sign that the market's getting close to a top. And there's less and less liquidity in the market. And that can also cause a panic in the market and cause markets to drop sharply. So it's warranted to have some caution and just be aware that the market is at extreme levels that we haven't seen before in the last 50 years, if not longer. All right, now let's talk about a couple of areas that I see that are undervalued. One of the undervalued markets that I'm loving right now is precious metals. And as you know, we've been a big fan of silver for a long time, and it was the number one performing asset this year and up 55% through August. Since that time, it's had a pullback of about 14% that I talked on that Jim Rickards podcast recently, and he did a great job explaining everything that was going on in the metals market. What we've seen right after that is metals start to take off. This is again because of a deteriorating value in the US dollar, which has dropped now to 90 cents. Precious metals have been on a tear and are up 2 to 5% per day the last 3 to 4 days. Just yesterday, our large gold mining companies were up 3.5%, our junior gold mining companies were up 4.45%, and our junior silver miners were up 5.79%. So the miners are reacting strongly to the weaker dollar and also being undervalued for such a very long time. So they're looking very inexpensive and looking like they want to move higher. Same thing in our cryptocurrency space. We're seeing Bitcoin at all-time highs, and although I'm not a fan of it, it does tend to move with the other altcoins. And we've seen article after article, and I've shared many of those with you, about all the institutional money, the wealthy investors, private wealth that's coming in to the cryptocurrency space. These investors are excited not only about the returns in cryptocurrencies, but about the fact that it's a different asset class. It isn't like a stock. It's dominating global currency and global payments. It's a store of value. It's an asset that will get more rare over time. It's a smart contract with instantaneous settlement by unlimited parties. It can generate income. It keeps accurate records. It reduces time to close transactions. It can calculate 1,500 transactions in 3 seconds. This is something completely different than a stock or a bond. And that's why this is a completely different asset class that isn't correlated with the stock market, isn't correlated with the bond market, but does have some correlation with the US dollar. And as the dollar tends to get weaker, people are finding cryptocurrencies as an alternate asset class to move into to maintain value. And while cryptocurrencies had a spectacular year this year and then have been experiencing a pullback, even our favorite cryptocurrency was up 26% in the last 24 hours. So things are moving quickly, moving back again to the upside for the cryptocurrencies. And this is something that we really want to watch with the US dollar. Now, the dollar has gotten so weak that I wouldn't be surprised if we saw a reversal and we saw it move higher for a bit. But nonetheless, this isn't about a short-term trend. This is about the dollar getting an erosion of purchasing power because there's so many that have been created this year. And should we get a stimulus package, again, that will be more dollars created. And ultimately, even if the dollar does reverse and move upward for a short period of time, it's bound to return to its trend lower again. That's the problem with having an unlimited supply of currency and it not being tied to anything of value. When you run the printing press, you run the risk of devaluation, just like we talked about in the podcast where landowner John Malone, billionaire and cable company CEO, was investing more in real assets, things like farmland. And that was the concern that he mentioned, was the devaluation of the currency. So this is what's on billionaires' minds right now. This is what's on people of wealth wanting to maintain their wealth. They want to keep their purchasing power. They want to find assets that are going up when the dollar's declining. And that's where we're finding a lot of interest in precious metals and in cryptocurrencies. So that's where I think having some of each in your portfolio is a great diversifier and is going to help you maintain a great return in your portfolio without the risk of the stock market right now being so overvalued and acting like a casino and being completely detached from the fundamental profits of corporations right now. But we'll see, and I'll be here to report on that and share all the information with you like I always do. So I will put a copy of this spectacular chart in the show notes in case you want to take a look at it. And I want to remind you our holiday review contest is ongoing. I'm giving away 10 of my Wealth Heiress books signed by me. That book was named to the all-time best wealth book list by Book Authority. I'm giving away 10 Wealthy Mindset Blueprint audio sets valued at $197 and 5 one-on-one wealth mentoring sessions with me. All you need to do is leave a podcast review on iTunes. That will get your name in the drawing one time. And if you've read the Wealth Heiress book and leave a book review on Amazon, that will get your name in the drawing 2 times. And I'll draw names and announce winners on January 13th. So be sure to mark that on your calendar and tune into that podcast to see if you've won. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.